All right, let's go ahead and get started. So a couple things. One, attendance sheet. Here is your attendance sheet. Make sure you sign that before you leave today. Start over here. Apparently on Monday, when I recorded the class in Zoom, I forgot to share my screen to Zoom. So it's just one long audio file. I was just talking to one of the TAs. We're going to try and find a previous semester version of this where I did this and post that so you kind of see what we did as an alternative. Otherwise, the audio file is there. But I just shared it correctly this time, so we shouldn't have that problem today. All right. So a few things. First, next Monday is your team presentation again on EIC. 10% of your semester grade. Again, you will be presenting from up here. You'll decide who will present on behalf of your team for the grade, preferably not all the team members. But over the 4 presentations, all team members must eventually present. So you got to figure out how you're going to split that out. And even if you're not presenting, you got to help create the presentation. Okay. Again, EIC, everything in the PowerPoint submitted by 10 a.m. One person submitted on behalf of your team. All your screenshots, including the RV markets beta and the spread, need to be in that PowerPoint that you're going to cover. All the 5 forces, today 5 years. Make sure you talk about all 5 forces using numbers. Competitive advantage, referring to the data. Today and 5 years from now, that's your presentation next Monday. And again, on Live Nation. Right? Now, questions about that presentation? Yes.
And for the industry live entertainment, and like from the drop down, the 2 options are entertainment and media. Like it's the entertainment facilities one to clarify.
How many companies are in that list? You might have to try and find a different comp source. I mean, what you're running into here with this assignment is a very real world issue, right? And so what I mean by that is when you do a benchmarking, multiple analysis, comparable analysis, whatever, like finding true peers is not always easy, right? So for example, if your assignment was on Disney, right? Well, Disney has theme parks. Disney also has Disney Plus streaming. Disney also has a cruise ship business, right? So who are the peers? I mean, for cruise ships, it's like Carnival, Royal Caribbean, but for streaming, it's going to be like Netflix. And for theme parks, it might be Six Flags. Well, that's 3 different industries, and you'd have to do all 3 in 10 minutes. So it gets a little bit more challenging. You got to explain 3 different industries. So same is true with Live Nation, right? So that's the point. That's why we sometimes have to make compromises when we do this industry analysis as to how we loosely define industry and peers. But that's what you got to have to try and figure out for Live Nation. So maybe you look at the company reported peer list. That might be an example of who the peers are. Or you look at GICs instead of BICs. But you're going to have to find more than 2 peers that represent this industry. And so either of those drop downs would not be enough.
On that note,
and if you find global peers, then you just got to make sure your I and the C talk about global. So it's a global 5 forces, not a US 5 forces. But yeah, absolutely. So I'll give you a little discretion. Good question. Any other questions? All right. So the last 2 things is 6 teams, 10 minutes. I'll be sitting there. You'll be up here presenting. If there's any volunteers, I'll take them to go first. Otherwise, I'll just, name all the teams. Everybody's got to eventually present on Monday. 10 minutes means 10 minutes, by the way. But the final thing I want to mention is a very important rule. Okay. So there's a couple things that are sort of the very important rules to me this semester. And one of them will be in effect on Monday. All right. When I'm up here teaching you, if you don't care what I say, if you're TikToking this entire class and chatting with your friends beneath your breath, whatever, it's your tuition. I don't have any, spilled milk by that. But on Monday, when your peers are presenting for 10% of your grade, Many of them are going to be very anxious and nervous, right? Because it's 10% of their grade. They don't, not used to presenting. It's a big deal, right? We don't need to make it any bigger. So when we have group presentations starting Monday, all computers off, laptops down, phones don't get touched, keyboards don't get touched. You'll sit politely and listen for 90 minutes, okay? If you're incapable of doing that, I would suggest not even bothering to come to the class, all right? Because I'm not going to give any warnings. And at any point in time, if I hear you making a sound, talking to somebody else, or typing on any keyboard or any phone, I will forcibly remove you from the room and dock your entire team 5% of their semester grade. Okay? It's clear? By the way, I did this last semester. Somebody's like, oh, he must be joking. I don't really have to pay attention, so I'm just going to do some other work. And when he got thrown out and the team lost 5% of the semester grade and everybody had to take the final exam because of that was on the team, they were pissed at that person for the rest of the semester, right? But again, it's just going to be on you. So these are one of the hard and fast rules that I have, but you will show respect to your peers that are presenting, just as they will show respect to you, right? And again, if you're capable of doing that, I suggest not coming to the right. Now, you got to go to the bathroom, whatever. Gently excuse yourself out, do it quietly, come back on either side of the room. Between presentations, talk. But when they're presenting their 10 minutes, cone of silence is down and we are respectful. That's a very important rule. I'll remind you about that on Monday, but that's just going to be true for all of the presentations. Right. Once you finish your presentation on Monday, later in the week, the peer reviews are due. You have to submit a peer review saying what percentage of effort each of your team members, including yourself, put into the presentation. Okay? Hopefully everybody's 100%, right? And if 2 or more of your team members say they didn't put in 100%, I will lower your grade. Okay? So very important that you participate in your team presentations, even if you're not the one that's presenting. All right. On Monday, we were doing the conversions and we got through 3 of the statements. Before we go any further, any questions about the conversion so far that we did? We converted income statements to TII, balance sheets to TFI, and then we did the cash flow of CFI, the income statement balance sheet. Right. So what I want to do is I put up in the files folder something called conversion video start 201. Somebody asked me to basically put up the file that was in the video that wasn't recorded in the files folder so you kind of see what file we had actually created together in class. So that's this file. That's where we ended up. And today we're going to pick up here and create a 4th tab, a 4th economic statement called economic profit, right? So we're going to create a new worksheet down here at the bottom called EP or economic profit. And economic profit is also known as economic value added or EVA, right? Except we can't call it EVA because Stern Stewart, the consulting firm, has trademarked EVA. So everybody else has to call it economic profit. It's basically the same thing, right? And what economic profit represents is a 1-period NPV, right? So NPV says, are we creating value over time? Economic profit says each year, did we create or destroy value this year? Did we create or destroy value next year? Okay, so it's a 1-period NPV, right? And it's just a quick way of analyzing a company, right? And I'll give you a practical example of this. Let's say Anheuser-Busch InBev, Budweiser Beer Company, decided that they wanted to dominate the beer market globally. So a number of years ago, they bought SAB Miller, another beer company, for $100 billion. Right? So essentially, how's that acquisition doing? Well, if I spend $100 billion, and let's just say my cost of capital is 10% on the acquisition, and 10% of 100 billion says I should be making incrementally 10 billion more every year, right? To justify the price that I pay. Well, I can tell you that in every year since that acquisition, they haven't generated $10 billion, right, per year more in profits. Right? So most years they did 3 to 5. So here's the point. If I needed to generate 10 and I only made 3, well, I'm short of what I need in order to create value out of that acquisition, right? And so that's a practical world example, real world example of how you would use an economic profit, right? So it's just a rule of thumb. Hey, what's going on in this period? In fact, if you forecast all the economic profits, you get your NPV. The only difference is NPV doesn't tell you when you created the value. Economic profit does. Okay? So for this worksheet, back to our simple company, we go to data, take row 1, copy it, put the years in, and then we start the first of 2 methods for estimating economic profit. The first method is called the spread method, right? We take our NOPAT off of our TII, so in the current year, we made 200 million, 210 million in NOPAT, and then divided by invested capital equals ROIC, equals from the TFI, operating invested capital, and that's going to get us ROIC. Now, in the assignment, I asked you to estimate BOY, ROIC, which stands for beginning of year, as opposed to EOY, which stands for end of year. Okay. So practically what that means is to calculate BOY ROIC, we would take the current year NOPAT and we divide by the prior year invested capital. That's BOY ROIC. And that would give us 55%. If I had asked you to do end of year EOY ROIC, you would take the 210 divided by the 440. And that would get you 48% for ROIC. Different numbers, right? And again, you might say, well, why do people do it differently? Well, again, let's say you're a chemical company and you're building a $1 billion terminal facility. It could take you 12 to 18 months to build the plant, right? Well, I don't want to penalize a company for work in process for something that they're not going to even use until next year if I'm trying to understand the performance of the current business. So I might use beginning of year ROIC to say, look, I'm going to exclude the work in process stuff and just say, what profit are they making on the assets they're actually using? That's beginning of year ROIC, right? Versus if I'm looking at Accenture or Deloitte or some consulting firm or Ernst & Young or Booz Allen, something like that, like if I hire engineers, well, I don't need to spend years building stuff. I'm going to give them some laptops and other, IT equipment or cloud-based stuff. I'm going to use that almost immediately. So the stuff I spend on CapEx is used pretty immediately. So end of year ROIC is probably more appropriate. So some companies actually use averages. They'll take this year's capital plus last year's capital divided by 2, right? But the point is, different perspectives on why you might use one or the other. But for this assignment, I'm telling you to use beginning of year ROIC, and this is the method. I'm going to eliminate row 5 just so it's not confusing here. Right. I'm also then going to give you a cost of capital, hurdle rate, or WACC. Let's say I give you 10%. Then we're going to have a spread of 55 minus the 10, which means I did 45% better than my WACC. Okay. So economic profit take my invested capital and multiply by my spread. Says if I started with $380 million and I made 45% above my WACC, I generated $172 million. That's called economic profit. Right? That's how many dollars above zero spread that I made in my 1 year NPV. That's economic profit based on beginning of year. If I had a negative spread, I'd have a negative economic profit. That's how much short of earning the profit I needed to kind of break even on a value standpoint. Method number 2 is the dollar method. Take my NOPAT, of 210 million, less something called a capital charge. This is my example I gave you with Anheuser-Busch InBev. If they spend $100 billion in acquisition and they're expected to make 10% a year, that 10 billion that they should make per year is called a capital charge. Right? I'm going to charge you for the investment that you made. Right? And so in this case, my capital charge is I started with 380 million, beginning of year capital, times I got to earn 10% WACC, says I needed to earn 38 million. So this is going to be IC times WACC. And so my economic profit would be the 210 million of profit I made minus the 38 I need to break even, 172. That's the balance. One's the spread method, percentage method. The other's the dollar method. Just kind of rearrange math, right? But those are the 4 statements that you need to convert. Okay, so you need the income statement to TII, balance sheet to TFI, create a CFI cash flow, create an economic profit based on beginning of it. This conceptually is what you're going to be doing for homework 4. Yes, sir. So you just take, for beginning of your ROIC, you take the current year NOPAT divided by last year's invested capital. So the idea at the beginning of the year, January 1st, is the same as December 31st last year. Other questions? All right, so for homework 4, it looks scary, but it's not. So the statement you're going to download has three years worth of data, right? And I know it looks scary because more data, but it doesn't matter. Like if you get the formulas right for the first year, you just copy and pasting over, right? So whether I gave you 3 years, 5 years, or 10 years, it would take the same amount of time. Okay. Now down the rows, there's a lot more items on here, but I gave you the labels, right? And so therefore you know where to put things. Just look at the label, right? And that's the whole idea. Like I actually thought, and I've just been lazy, that I was going to one day do an assignment where I wouldn't tell you things like revenue and operating cost depreciation. I would just say A, B, C, D, E, F, G and label them 1, 2, 3, 4s, right? And you just thought, oh, this is an asset 1, therefore it goes here. This is a liability 1, I net that. This is an asset 2, goes here, right? And in a way, that's your assignment. It's just putting all of these items on the income statement and balance sheet into the right Modigliani-Miller bucket, netting the assets assets against liabilities for operating and non-operating. Anything interest bearing goes in the debt bucket, anything equity goes in the equity bucket. Right? And then you can convert and create your cash flows, etc. So it's not as hard as you think, but obviously, first time you do it, it could take you some time. There's also a couple of accounting terms on here that some people may have forgotten. So I want to remind you of this. So one of them is something called minority interest. You're going to see minority interest on the income statement, and you're going to see minority interest in the balance sheet. Okay? And so to remind you where this comes from. When a company basically owns another company that it controls, but it doesn't own 100% of. So I own 50 more percent, but not 100%. Okay? Under accounting rules, I consolidate the company. I literally take all their revenue and all their assets, and I treat it as my own. Okay, so I just add them in, absorb the whole thing. But I don't own 100% of the company. Somebody else owns a minority share of those assets and profits. That is called a minority interest, right? It's kind of like a quasi-liability. So I owe a share of the profits of the assets that I control to that minority shareholder. And that minority shareholder doesn't get equity on all of my assets, like a common shareholder. They only get the percentage of the profits on the share, the profits that I have absorbed and controlled. Okay. So that's their stake in those assets. It's called a minority interest. So it's equity, quasi-liability. I owe that to the shareholders. They can't vote. All right. They're not common shareholders getting access to anything, but that's called a minority interest. It'll show up right at the section between liabilities and equity on a balance sheet. Okay. That is this row. Now, the government doesn't want to be chasing down everybody for taxes. What they say is, if you control a business, you pay all the taxes on the business. So as the minority owner or the majority owner, I pay 100% of the taxes, including the taxes on the minority stake. Okay? Then, after tax, I give the portion of the profits that belong to the minority shareholder for their minority investment a distribution, which is a dividend. That is the minority interest on the income statement. That is a distribution of cash to the minority shareholder for their share of the profits in the business that I control after tax. Right? And so here's another rule of thumb. You see row 9, income before tax. Everything above income before tax is a pre-tax number. Everything below income before tax is an after-tax number. So when you're doing your assignment, you're like, oh, do I need to tax affect this? Well, look, interest income is above income before tax. Therefore, I have to tax affect it. Amount times 1 month's tax rate. Minority interest is below interest before income before tax. It's already tax has been paid. So I don't tax affect that dividend to the minority shareholders because the taxes have already been taken out. So that's just accounting. Right? But another important thing when you're trying to do your TIS. You have questions about any of that? And the final account on here to remind you of is something called treasury stock. Okay. Companies issue stock at book value. Companies buy back stock at market value. The dollar value of the repurchased shares is called treasury stock. That dollar value is listed as a contra account to equity. So it's a negative. Okay. So if you see treasury stock of -5, that means $5 million of stock has been bought back. If you see 250, that means 250 has been bought back. If I'm thinking about cash flow, the difference between 5 and 250 is how much stock was bought back that year. Okay. So when treasury stock goes up, that's a cash flow, right? Because I'm buying back more stock at market prices, and that reduces equity. Okay. And that's called treasury stock. So that's on here as well. So other than that, this is the assignment. Gave you WAC, gave you tax rate, told you use BOI capital for ROIC and EP, and I gave you a formula for capital expenditures if you need it. But regardless, this is the assignment. Questions? This is homework 4. Due Monday, with 10 a.m. All right, homework 5. Homework 5 involves custom formulas and the equity screening tool. So on Monday, I talked to you about operating ROIC as opposed to traditional ROIC, which is an average. And operating ROIC is not the average, it just looks at the operating capital and the operating investment and the operating profits. Okay. And I told you why that might be more valuable for analysis and forecasting. Right. Problem is, operating ROIC does not exist in Bloomberg. Okay. But Bloomberg, as you know from your certification, allows you to create custom fields and custom formulas. Now they're unique to your account, which is why everybody's got to do the assignment. But in order to estimate operating ROIC this semester, we got to create it. And that's homework 5. Okay. So there are 2 areas in Bloomberg in which you can create custom formulas. One is RV, the other is EQS. All right. So I'm going to go to RV. And let's say I'm on Verizon. So you go to custom, click on the gear icon right here, and you click add formula. And this will bring up the custom formula builder. Okay. Now, you'll start here where it says function. And if you go to the homework assignment, homework 5, the first custom formula you have to do is no plat. All right. So no plat doesn't exist in Bloomberg. That's a McKinsey term. Right. And we define no plat as operating income times 1 minus the tax rate. So we're going to create a custom formula to put no plat in our terminal. So we're going to start out with latest FY operating income or loss. So here it says function. Start typing in operating income or loss. And we want to make sure we choose latest year. When you hit enter, in the middle box, the database field pops up. Right. Now I could, if I knew the database field and I'm a programmer and I was familiar with it, I could just start with the database fields. But if you don't know the database fields, you put in the friendly name and Bloomberg puts that database field in. So that's the database field. So IS Oper Inc. is basically the operating income or loss, right? And it says do it in US dollars and do it for the fiscal year. Okay. So that's the first part of my form. Now, following order of operations, I put a left paren beginning, and then I multiply by left paren 1 minus left paren, and then the next field in the formula is I need the effective tax rate. So go back up here to function, effective tax rate, again for the latest year, hit enter. There's the effective tax rate, and then I'm going to divide that by 100. You're like, why is he dividing it by 100? Because I know that Bloomberg takes 21% tax rate and stores it as 21, right? And so if I do formula 1 minus 21, well, that's going to kind of screw things up. So I need to do 1 minus 0.21, right? So to do that, tax rate divided by 100. That's why I do divide by 100. And then right paren, and when you're done, you hit enter. All right. Now, if you screw up, which I just did, my order of operations, it won't complete the formula. So it basically says I got too many or not enough parens. So just count. 1, 2, 3. Got 3 left parens. 1, 2, 3, 4 left parens. And I got 1, 2. Where's my mistake? Just one too many? No. Start this again. There's this one. That closes that. That was my problem. No. That closes that. Times 1 minus that. All right. What do I do with my formulas? Why did I screw this up? Where? At the end? Do I have to? Did I put the one in? Did it go in? There we go. So the nice thing about Bloomberg is if you're an idiot professor and you can't put your order of operations in correctly and follow directions, it won't let you complete it in an incorrect formula. All right, but once you put it in correctly, hit enter, the formula's there. Now, since I was on Verizon, it'll pick just a couple of random companies over here to put in the dollar amount of NOPLAT, right? But here's the point. Once I do this, I can either save and use an RV or hit save. So hit save, and I'll call this my NOPLAT fall 24. There, and I'll save this, right, which I had done in the previous class. So 2, 4, 1. All right. It could take, as you do this, when you save it, up to 2 minutes for this custom formula to appear in your database. Okay. But here's the point. If I go back and then now I type in my NOPLAT from the fall of 24-1, which I just did, I hit enter, then there is the NOPLAT for every one of those companies that's estimated by Bloomberg with the custom formula. Okay. So that's the idea of a custom formula. So if I'm going to do operating ROIC, I need a NOPLAT. So we created a custom profit, the NOPLAT, P. Now divided by operating invested capital. So I'm going to create 4 more custom formulas. And that's the point. Once you create a custom formula, you can use it to build other custom formulas, or you can use it for screening, right? So you need one for NOPLAT. Custom formula number 2, you're going to have to do one for operating cash, right? So on Monday, I referred to this. I said companies report cash, but in this class, we're going to distinguish between operating cash and excess cash. There's some cash that you need to run the business day to day that you can never pay out, right? So when I was CFO of a subsidiary of Blue Shield, California, right, and I was running the Bay Area physician network, and so a $21 billion company, I had a $400 million subsidiary, right? And corporate would ask me, how much cash do you need on hand to run your business and how much can you send to me? Kind of new. I was like, there's some amount of cash I can never send back to Sacramento because we have to keep this amount of cash to run our business day to day. That's called operating cash, right? And you can talk to most CFOs or treasurers and just ask them, say, hell, how much cash do you need to run your business? That cash can never be paid out. The rest of it, excess cash, right, I can do different stuff with that. So we're going to distinguish that. But most companies don't do that. They don't report that publicly, right? So in this class, we're going to use a rule of thumb. We're going to define with a custom formula, operating cash is 2% of revenue. Custom formula number 2, right? 2% of revenue represents 1 week of sales. So it's another way of saying everybody needs at least a week of cash to run your business, right? Realistically, it's probably a higher number than that, but you need at least 1 week. So for our purposes, 2% of revenue, operating cash. Everything above that, excess cash. custom formula number 2. Custom formula number 3, operating working capital. This is different than the accounting definition of working capital. Accountants look at working capital differently. They do all current assets minus all current liabilities. We don't do that. We do operating current assets, which means excess cash is a 2. It's not part of current assets. We take it out. Short-term debt is not part of current liabilities. That's a 3. That's interest-bearing debt. We take it out of current liabilities. So when we estimate operating working capital, OpWC for short, we exclude some things. So therefore, we need a custom formula for that, because that's not a formula in Bloomberg. So operating working capital starts with the operating cash, previous formula, adds in the latest year accounts receivable, plus the inventories, plus the other current assets, minus the accounts payable, minus the other short-term liabilities. Custom formula number 3. Custom formula number 4 is operating invested capital. We'll take the operating working capital that we just created, add into it the property, plant, and equipment, and the goodwill. Custom formula number 5 is the operating ROIC. It's the NOPLAT divided by the operating invested capital. Okay, so as part of your assignment, you need to create an operating ROIC. Okay? Doesn't exist in Bloomberg now. It's based on a bunch of custom formulas. Once you do that, we're going to use that formula consistently for the rest of the semester. So you need to do it not only for this assignment, but for others. Now, technically for your EIC on Monday, when you do industry should be based on operating ROIC, not average ROIC. But I'm not going to ask you to do that on Monday. So Monday is still traditional Bloomberg ROIC, but going forward, we're probably going to start using operating ROIC to reflect the true performance of the businesses. Questions about that? Once you've created these custom formulas, which you can use in Bloomberg. So for example, if I go to Verizon, add column, operating cash, there it is. That operating cash says formulas. That means it's a custom field. So I have a bunch of custom fields already created, as opposed to a Bloomberg field, which are the standard ones, but they'll be intermixed. So my custom formulas will now be part of my Bloomberg account. Now, next, once I've done this, I go to EQS, which is the equity screening tool. Very powerful part of Bloomberg, which you should have learned about in your BMC certification. What BMC or what EQS allows you to do is Bloomberg has 1.6 million securities in its database worldwide. You can sort and filter and report and slice and dice on any criteria you want, and basically get what's called equity screens. So your second part of the homework 5 is what we're going to do is we're going to take the S&P 500. So it says add criteria. SPX is the S&P 500. We're going to hit enter. And we're going to basically take 1.67 million companies and we're going to bring it down to 500. Right? Now it says 503 companies. Like, I thought the S&P 500 had 500 companies. Why does it say 503? And the answer is because there's 3 dual listed stocks with 2 categories of equity in the S&P 500. Google is one of them. Google/Alphabet. They have 2 shares. They have GOOG and they have GOOGL because they have a Class A and a Class B shares. So even though it's one company, both shares are in the S&P 500 index. So it's 500 companies, 503 securities. I think Meta is another company. I forgot who the third is. Okay. But that's the S&P 500. Okay. Next, second criteria. This is the and. Companies with an op ROIC, custom formula, greater than 20, which is 20%. So of the 503 companies, 500 companies, 141 of them had an operating ROIC greater than 20% last year. Okay. So make sure, type this in correctly, greater than 20, not 0.20. Next criteria, and had revenue growth year over year greater than 15. So add criteria, revenue growth year over year, and make sure make sure you don't do latest quarter. You got to switch this to latest year. Right? Because otherwise it'll just do same quarter last year. And that's not the right answer. This is basically annual data. So greater than 15%. So that's going to take 141 companies and screen down to 15. So there were 15 companies last year in the S&P 500 that grew faster than 15% and had an operating ROIC greater than 20. And my third criteria, and that had a bull beta greater than 2. Greater than 2. And that brings me to 4 companies. Right? Now you guys might all be familiar with beta. You heard of bull beta? Here's the idea. Bull beta says calculate a beta on only up days. So just find all the up days in the market, exclude the down days in the market, and calculate the beta based on only up days. So the idea is when the market goes up, how does those companies go relative to the market? Right? Whereas there's also something called the bear beta. The bear beta says calculate a beta on only the down days. So when the market goes down, how does that company do when the market goes down, excluding all the up days? Okay. So if you're thinking about your trading challenge, you're like, oh, the market's doing, going up right now. Which companies are going up much faster in a good market? That's bull beta, historically. So there's 4 companies in this list. Scroll down, see results. These are the 4 companies. It would be Palantir, NVIDIA, Arista, Dexcom. That's the first half of homework 5, this screenshot. You got to get to the screenshot by putting in that criteria. And you can't have that criteria unless you put in the custom formulas. Questions about any of this? By the way, each one of these companies, NVIDIA's bull beta is 3.3. That means the last 2 years, if the market went up 1% on any given day, NVIDIA went up 3.3% just on the upside days. So the market was up, NVIDIA was up a whole lot. On any given day, Palantir was up almost 2.89% every time the market went up 1%. So on good days, Palantir did really well. That's the idea of the bull beta. All right. So screenshot up here, save, submit, 1 point. Questions about this part of the assignment? But I go back to equity screening tool. If you go back, you can also actions save this as a custom screen. So over here are my save screens. So for example, every quarter, I write an academic article in a Duke journal. And every year, one of my articles is global cycle time rankings on companies in the US and Europe. So this is custom criteria for companies in Europe. It's called the Stock 600. And so instead of having to do this, all this academic research, I literally just one button click on the screen, export the data, I'm done. It takes about 5 minutes to write the article. Right? Don't tell the Duke people that, but regardless, it's much easier to do with a custom screen. Another thing is custom screens can help with the trade challenge. So for example, you can screen on almost any criteria. You could say, show me companies in the S&P 500 that have product revenue greater than X% in energy. Okay, so who's going to be tied to the energy business, right? Or show me companies in the S&P 500 that have 20% of the segment revenue in China. So if we really believe there's going to be a trade war between the US and China, who might be more likely to be affected by that? Same thing. Show me companies listed in Hong Kong that have a high percentage of revenue in the US, right? So if we're slapping a bunch of tariffs on companies, like those are the ones that are going to be most likely impacted that. So equity screening can be very, very powerful. And so again, I'd encourage you to do this not only for this assignment, but to use this in your trading challenge to help you identify some stocks. You can pick just about any criteria and filter and sort. The other half of homework 5 is to go to Microsoft, do an RV, go to custom, and create a spread based on operating ROIC. Add column, op ROIC, enter, add column, whack. And enter. There it goes. That's the point. You can't get this unless you have an operating ROIC. It's got to have the custom form. And by the way, this is your original screenshot. ROIC latest year. So this is Bloomberg ROIC. So what's interesting is that for Oracle, there's not much of a difference in operating and average ROIC, because Oracle doesn't have a lot of non-operating assets. Microsoft does. Their average ROIC is 28.74%, and their operating ROIC is 35%. So that's what I mean by, if I'm valuing them, knowing that when they sell their software and Xbox and cloud services, they're making 35% a year, not 29% on that stuff. But regardless, this is your assignment. All right, questions about homework 5? The equity screening tool, custom formulas, anything we just did. Again, also due Monday. So TAs have office hours the next 2 days. I told them to expect a bunch of people. They're prepared. So take advantage of that if you're confused. And I know this weekend, some of you are going to be cursing me and you'll be like, damn, it's too late to drop this class. This sucks, right? I don't like doing this because it's like learning a new language, right? But I want to give you the light at the end of the tunnel, which is not an oncoming train, right? Why are we doing all of this? Okay, so here's what's next. So we go back to our lecture notes. Once we convert statements, we are going to do 2 types of analysis. We're going to do 5-year historical ROIC trees, and we're going to do CFI analysis historically at companies. And we're going to get a much better idea of what's happening with companies. And this is very real world. Okay. So when we analyze ROIC, there are 3 things that drive operating ROIC: tax rate, margin, productivity. Those are called the first level drivers. Those 3 things will explain the change of ROIC of any company. We'll then do second level drivers. What drives margin? Well, that's the income statement. So Gross margin, SG&A, depreciation. What drives productivity? That's the balance sheet. That's working capital, PP, and the intangibles. So we'll look at the drivers of changes in ROIC over time. So I'm going to give you a very real world example here. So here is an ROIC tree for a company called Verizon. Okay. So this is next week's homework assignment. Won't be on Verizon, but this is what we're going to get into next. Once we've converted to operating ROIC, this is based on end of year data, EOY, right? And the idea is in 2019, Verizon's ROIC was 10.6%. In 2023, Verizon's ROIC fell to 5%. That's a 52.4% decline in their ROIC over the last 5 years, right? So Verizon's share price has been a little choppy, and this is one of the reasons why. They're making less return on what they do. Why? Reason number one, tax rate. In 2019, Verizon paid 13% effective tax rate. In 2023, they paid 28.8% effective tax rate. Is that favorable or unfavorable to your ROIC? Pay a lot more in taxes. Your ROIC go up or down? Goes down. So one of the reasons why Verizon's ROIC went down is because they're paying a lot more in taxes. Driver number one. When we take out the impact of taxes, we get what's called the pre-tax ROIC. What's going on with the underlying business? Selling cell phones, data services. In 2019, Verizon's pre-tax ROIC was 12%. In 2023, it fell to 7.1%. So the underlying business at Verizon also got worse. Not just they were paying more in taxes, the underlying ROIC got worse. Continuing to the second and third drivers. Operating margin. When Verizon sold you a product in 2019, they made a 23% margin. Selling the same products in 2023, they're making a 17% margin. They're making 6 cents less per dollar when you buy one of their products. Is that favorable or unfavorable to ROIC? Well, it's pretty unfavorable. You're making less every time you sell something, you're going to lower profit, lower ROIC. Driver number three. To generate $1 of sales in 2019, Verizon invested $1.89, so $1.90 in invested capital. So they spent $1.90 to generate $1 of sales, capital intensive business. In 2023, to generate the same dollar sales, Verizon invested $2.42. Is that favorable or unfavorable to ROIC? It's pretty unfavorable. They're spending 50 cents more to sell the same stuff. All three drivers are causing Verizon's ROIC to go down. They're spending 50 cents more per dollar to drive $1 of sales. They make 6 cents less every time they sell that dollar. And they're paying higher taxes for that purpose. When you put all that together, it's pretty clear why Verizon's share price has not been doing well. Second level drivers. Why did their margin go down 6 cents? Three parts of the income statement. Gross margin minus SG&A minus depreciation equals operating margin. So gross margin, price minus cost of goods sold. 2019, 71 cents. 2023, 72 cents. They're actually making more price minus cost of goods sold on the products they're selling. That's not where their operating margin went down. Spending on SG&A / overhead. 2019, they spent 35.5 cents on SG&A per dollar sales. 2023, they're spending 42 cents per dollar on SG&A / overhead. That's what's killing their margin. They're spending 6 cents more on marketing and sales and overhead, admin costs, to sell you the product. Depreciation went from 12.7 cents per dollar in 19, 13% in 23. So that hurt them a little bit. But the real story here is the big increase in SG&A led to the drop in the operating margin. Second level driver for the balance sheet. Invested capital, OpWC is working capital. Working capital plus property, plant, equipment plus goodwill and intangibles equals invested capital to sales. Verizon's working capital went from 5 cents per dollar to 1 cent per dollar. That's better. They got more efficient, less inventory. Spending on the network, PP&E. They went from spending 86.9 cents per dollar, 87 cents per dollar of sales to 99 cents per dollar of sales. Spending a lot more on their network to drive the same amount of sales. And intangibles. They went from 98 cents to $1.45. They bought somebody. Spent a lot of money on an acquisition. So they spent a lot of money in acquisition, spent more on the network, and they didn't get more sales. Now, by the way, let's put ourselves in the real world. Maybe they're investing now in all this balance sheet stuff because they think it's going to pay off later. So we go to Verizon's EEO. And we look at the next 4 years. And if I look at revenue growth rate, 1%, 2%, 1%, 1%. There's no growth over the next 4 years. This is the problem that Wall Street has today with Verizon. Is they spent a ton of money over the last 5 years, and there's no growth coming out of it. So you just have more investment for the same sales. Well, that's going to hurt your ROIC, and it's going to stay low for a while. And by the way, they're doing it on less margins. So what I'm saying is, you're going to hate the conversions. But when you do the conversions, you get to this. And this is a much better understanding of what's happening with a company. Now, the other part is the context. What's going on with Verizon, right? They basically have two businesses. One, landline phones. By show of hands, how many people in this room have a landline phone? Exactly. No one. That business is dying, right? So they're not making any revenue growth there. It's actually shrinking year over year. All right, they're losing 6 to 10% of their customers every year, cutting back on the cord. There's no growth there. The other business is cell phones. Does anybody not have a cell phone in this room? Problem number two. Everybody's got a cell phone, not just in the US, but globally. And it's not even us, it's people younger than us. Teenagers have cell phones. Everybody's got a cell phone. So how do I sell more cell phones and data plans if everybody's got one? So that's the problem. They're just not getting a lot of growth. And that's not just Verizon, that's AT&T and T-Mobile. And oh, by the way, to grow, it's competitive. Because I basically have to convince you to switch from AT&T to Verizon if I want to grow. Because you already got a phone in the plan, right? So they're fighting over this. That's the SG&A spend. Matter of fact, iPhone. Every player right now is giving at least $1,000 to upgrade to the iPhone 16, which means if you switch, it's a free phone for the basic iPhone 16 model. You get it for free. Well, that's hurting their profits. That's the spend. It's competitive. Okay? It's tough EIC. A lot of rivalry in this industry because there's no growth. Right? So here's the other challenge Verizon has. It has to do with 5G. Okay? So when 5G was launched, there's kind of 3 speeds to 5G. Okay? The super fast 5G is called ultra wideband, which uses very high frequencies. But the problem with that super high speed 5G is because it uses such high frequencies, those frequencies do not penetrate walls and windows. So you pretty much have to be standing within a block of the tower to get those ultra high speeds. And so practically you're not getting it, right? Because there's just not enough towers to go around unless you're in the heart of a city. And they don't spend the money to put those in the smaller towns and the rural suburban areas. Then they go to the low side of 5G, which uses much lower frequencies that travel longer distances, but the lower frequencies can penetrate walls. Unfortunately, they don't carry as much data. And so therefore, it's not much faster than 4G LTE. It's just kind of like rebranded, but more efficient for the carriers. So in the middle, something called C-band, which is the Goldilocks. It goes further and penetrates walls, and it's much faster, but it's not as fast as super high speed stuff. So translation, you get like 40 to 50 megabits per second on low 5G. You get 300 to 500 megabits per second speed in mid-band, and you get well over a gigabit in high band, right? The problem is that when 5G went national a number of years ago, the only company that had mid-band spectrum was T-Mobile. So Verizon and AT&T didn't have it, right? T-Mobile did. And so that's actually why I switched to Verizon. Like I now have a Verizon or an T-Mobile cell phone because they have the fastest practical network in the United States. At the time, it had a huge amount of capacity because not a lot of people were on T-Mobile. And so they've been trying to grow it. And so it was great, right? So AT&T and Verizon competitively had to buy that mid-band C spectrum. So Verizon spent $60 billion buying this mid-band spectrum. That's a huge amount of investment. You see it on the ROIC trade. That's one of the reasons why the PP&E went up so much, right? But here's the problem. They spent $60 billion. They made all this investment. How much more sales are they getting out of this? They're not. And so if you spend $60 billion and you don't get a lot more sales, your ROIC goes way down, your cash flow goes down. And oh, by the way you are growing is you're fighting it out in a death match to get share from somebody else. Well, that's not helping your profits. So if you're thinking about what's going on, that's Verizon's challenge right here. And by the way, that's AT&T's challenge, and that's T-Mobile's challenge in the United States because there's no growth in the market, right? And so I'm just telling you, these are the things that when we put things in an economic format become really, really clear that you don't always get from the traditional accounting. Okay. So as much as you hate what you're about to do, this is the benefit. This is very real world, right? When I was at Verizon a month ago, this is what I was talking about the senior execs about. The whole question is why is their stock price not going up? And again, I'm not trying to be the bearer of bad news, but it's like, here's the data, right? You can see the data. This is what Wall Street's looking at. Why would they want to invest in this story? Right? That's why your stock price isn't going up. Right? It's pretty obvious, right? So in a couple of weeks, why is Starbucks in trouble? Why did they fire their CEO? Well, you're going to see when we look at this data, why. The data's going to become really clear. Why did Southwest abandon free seats and start charging for seats, and they're about to abandon bag fees? You're going to see the poor performance in Southwest. Matter of fact, today they pulled out of Atlanta, right? Because it's really clear the challenges they're having financially, right? Why is, I'll pick another company, Nike. Why did Nike fire their CEO, right? What's going on with Nike? It'll be very clear in the economic data, okay? So in order to do this, we got to put this in this format. I always feel it'd be great if the accounts did it, but they don't, okay? So they give us this other weird FASB gap crap. That's just paper, shuffling around a lot of stuff that doesn't really tell you how much cash you're generating today. It tells you over time what you're going to make, which is important, but I need to know today. And so that is the economic statement analysis that we're going to do. So just trying to show you that there's a benefit when you're cursing these two assignments about why you need. But regardless, you got to do homework 4 and 5. So questions, comments, concerns, crippling fears. Did everybody sign the attendance sheet? Make sure you sign it. If you didn't, before you leave, where's the attendance sheet, by the way? Where'd it go? You got it over there. Okay. And other than that, work with your teams. TAs are available for office hours. Can't wait to hear what you have to say about Live Nation on Monday. Good luck.